You were taught that bank failures are rare, unpredictable events. That's not true. Right now, two American banks are showing the exact same warning signs that appeared before the crash of 1929. The same patterns that preceded 2008. The same structural cracks that regulators missed or ignored every single time. Most people won't notice until it's already happened. And once you see what really happened, you can't unsee it. Welcome to the wealth timeline, where money, power, and history quietly shape the world around us, because the institutions we trust most are often the ones carrying the greatest risk. And the warning signs? They're already visible. Banks don't collapse overnight. They decay in stages. First comes overconfidence, then comes leverage, then comes the moment when assets that were supposed to be safe turn out to be anything but. In March 2023, Silicon Valley Bank failed in less than 48 hours. It was the second largest bank failure in American history. Signature Bank collapsed the same weekend. First Republic followed 2 months later. The government stepped in. Depositors were made whole. The crisis, we were told, was contained. But containment doesn't mean resolution. What no one noticed was the cost. To understand what's happening now, you need to understand how we got here. After the 2008 financial crisis, the Federal Reserve did something unprecedented. It dropped interest rates to near zero and kept them there for over a decade. The goal was to stimulate lending, support the economy, and prevent deflation. It worked. Credit was cheap. Markets rallied. Banks loaded their balance sheets with long-term bonds, U.S. Treasuries, mortgage-backed securities, assets considered ultra-safe. And they were safe, as long as interest rates stayed low. But the Federal Reserve made one critical assumption, that inflation would remain dormant, that rates could stay low indefinitely, that the system built on cheap money would never have to unwind. By 2021, that assumption was already breaking. It worked, but only under conditions that would not last. Between 2020 and 2022, deposits flooded into the banking system. Pandemic stimulus, corporate cash, venture capital dry powder. Banks were suddenly awash in money. They did what banks always do. They invested it. They bought government bonds, long-term bonds, safe, stable, predictable returns. Except there was a problem baked into the strategy. When interest rates rise, the value of existing bonds falls. A 10-year Treasury bond paying 1.5% becomes worthless if new bonds are paying 4.5%. On paper, the banks were solvent. In reality, their assets were bleeding value. This is called duration risk. And by 2022, the entire banking sector was sitting on over $620 billion in unrealized losses. Temporary solution, short-term stability, unintended consequence. Regulators knew, the banks knew, but as long as depositors didn't panic, the losses stayed hidden, marked held to maturity and kept off the balance sheet. The stronger it became, the harder it was to stop. In March 2023, something shifted. Silicon Valley Bank's clients, mostly tech startups, started withdrawing deposits. Fast. The bank needed liquidity, so it did the one thing it couldn't afford to do. It sold bonds at a loss. $1.8 billion vanished in a single transaction. The bank announced the loss publicly, hoping to raise capital. Instead, it triggered a bank run. Within 48 hours, customers tried to withdraw $42 billion. The bank collapsed. This wasn't a subprime mortgage crisis. This wasn't risky loans or fraud. This was interest rate risk, one of the most basic dangers in banking, and it destroyed a $200 billion institution in 2 days. The Federal Reserve and the FDIC moved quickly. They guaranteed all deposits, even those above the $250,000 insurance limit. They opened emergency lending facilities. They stopped the contagion, but they didn't stop the problem. Right now, two mid-sized U.S. banks are exhibiting the same signs. New York Community Bancorp and a smaller regional lender showing stress in commercial real estate portfolios. Both are experiencing deposit outflows. Both are sitting on underwater bond portfolios. Both are trying to reassure investors while quietly shoring up capital. Nothing collapsed, and that was the problem. Here's what makes this moment dangerous. In 1929, the warning signs appeared months before the crash. Banks were overextended. Margin debt was at record highs. But confidence held, until it didn't. When the panic started, it spread faster than regulators could respond. In 2008, the warning signs were visible for over a year. Rising foreclosures, subprime exposure, credit rating downgrades. Institutions reassured the public, right up until Lehman Brothers collapsed in a single weekend. The pattern is always the same. Gradual stress, institutional denial, sudden collapse. Today, the Federal Reserve has raised interest rates at the fastest pace in 4 decades. Every increase makes old bonds worth less. Every increase pressures banks with long-duration assets. Every increase tests whether the system can handle the unwind. And here's the critical fact. Over 700 U.S. banks are currently considered troubled by the FDIC's internal metrics. Not failed, not insolvent, just stressed. The two banks showing cracks right now aren't outliers. They're early indicators. From this point on, the outcome was no longer optional. So who benefits when banks fail? The depositors, protected by government guarantees. The executives, often walking away with severance packages. The lawyers and consultants managing the liquidation. Who absorbs the cost? The FDIC insurance fund, which gets replenished by charging higher premiums to surviving banks. Those banks pass the cost to customers through fees and lower interest on deposits. Taxpayers, indirectly, through economic disruption and slower growth. When Silicon Valley Bank collapsed, the government intervened to prevent panic. That intervention worked. But it also set a precedent. Large depositors now expect to be made whole regardless of insurance limits. This creates moral hazard. It encourages risk-taking. It quietly shifts the burden from private institutions to the public system. Power didn't collapse. It just moved. The institutions that survive consolidate. The regulations that follow favor scale over competition. The banking system becomes more concentrated, not less fragile. Here's what history teaches. Bank failures cluster, not because banks are stupid, but because they respond to the same incentives. They follow the same strategies. They make the same assumptions about risk. When one bank shows cracks, it's a signal that others might be carrying the same hidden stress. The question isn't whether more banks will face pressure. The question is whether the system can absorb the losses without triggering a cascade. Right now, we're in the waiting phase. The phase where confidence matters more than capital. Where perception determines survival. History doesn't repeat events. It repeats incentives. 2 takeaways. First, systems optimized for stability often carry hidden fragility. The safer something appears, the more dangerous the surprises become. Second, financial crises don't announce themselves. They emerge gradually, then accelerate suddenly. By the time everyone sees the problem, it's already too late to prevent it. Because in the world of wealth and power, history never ends. It just changes hands. If you enjoyed uncovering this hidden chapter of history, make sure to like this video, subscribe to the Wealth Timeline, and turn on the bell icon, because the next story might just change how you see power itself.